So far, our Sustainable Investment series has tackled terminology and provided insight into implementation. In our third and final installment, we will discuss everyone's favorite topic, compliance and reporting. While last but certainly not least, compliance and reporting plays an important role in any sustainable investment portfolio. Whether the portfolio is focused on ESG integration, SRI, or impact investing, sustainability compliance is what ensures that the portfolio is indeed invested consistent with the impact investment policy statement. It's also important to a sustainable portfolio as any traditional metrics such as market capitalization, style consistency, and sector exposure. Going hand in hand with compliance is reporting. This is how we, as the investment consultant, are able to determine how our clients' managers are addressing sustainability issues. Reporting is only as good as the underlying data, which is why we include reporting capabilities as part of the initial manager due diligence process. That being said, reporting has long been the Achilles heel of sustainable investing, since there is no standardized method for conveying the outcomes of these investment themes. For example, a client focused on sustainable energy may have one manager reporting on fossil fuels, while another is reporting on carbon intensity. For these reasons, the impact investment policy statement should provide some guidance on which metrics to use, or at least which metrics is deemed most important to the investor. To help in creating a true apples-to-apples comparison, data providers like MSCI have developed robust reporting that analyzes total portfolios from various sustainability perspectives. Investment consultants are then able to leverage this reporting to help clients assess manager compliance with their sustainable strategies. With SRI strategies, another way to review compliance is an annual assessment of the companies that were not purchased as a result of the SRI screens in place. This can also be used to examine companies that were purchased due to positive screening. This helps to ensure that the underlying holdings are indeed being monitored and that clients are comfortable with any tracking error that is a result of the specific screening in place. In the last session, we talked about the United Nations Sustainable Development Goals, referred to as the SDGs, and how the SDGs are emerging as a translation of sorts used by companies, managers, and investors alike. For this reason, we recommend prioritizing and incorporating the SDGs in any impact investment policy statement. As managers continue to incorporate the SDGs in their own reporting, this will help to align the investment objectives of the client with the underlying investment themes of the manager or fund. I had mentioned earlier that reporting has historically been an issue, primarily because of many of the impacts that are being assessed are more qualitative in nature rather than quantitative, and tend to focus on policy initiatives. As such, the SDGs provide for a nice reporting guide to illustrate to investors how their assets are driving change in the sustainable space. Thanks for taking the time to listen to this series. We hope you learn more about the basics of sustainable investing